Hey everyone, ready for another deep dive? Today we're taking a close look at Funds India's Wealth Conversations report.
Yeah, this one dropped just last month, January 2025.
It's jam-packed with long-term investment insights, not just for equities, but for debt, gold, real estate, you name it.
Think of this deep dive as like a cheat sheet to really understanding how equity markets tick.
Exactly. And by the time we're done, you'll have a way better idea of what kind of returns you can expect from those equities over the long haul.
Not just that, we'll cover those nail-biting ups and downs, the whole volatility thing.
And we'll dig into why sometimes just staying invested
Right, just staying put.
can actually be smarter than, trying to be a market timing guru.
Right. No crystal ball needed.
So let's kick things off with the big picture. Indian equities, what's the long-term story there?
Well, this report points out that over the past 20 years, Indian equities have given you, on average, around a 14% return annually.
So, if I'd chucked, say, 10,000 into Indian equities 20 years ago.
You'd be sitting pretty with about 1,050,000 today.
Not bad.
Not bad at all. And get this, if we zoom out even further, to July 1990,
Okay, way back.
the Nifty Y50 index, which tracks 50 of those big Indian companies,
Right, the heavy hitters.
it's grown, get this, 85 times.
85 times. Hold on, so you're saying 10,000 back then?
Could be close to 1,000,000 rupees now, absolutely.
That's the magic of compounding, huh? Over 30 plus years.
34 to be exact. And that's an annualized return of about 13.7%. But here's the thing, it's not all about the index.
Right.
This report dives into some seriously well-managed mutual funds that have actually done even better than the Nifty Y50
Oh, interesting. So if someone wants to aim for even higher returns,
than just the market average.
those funds might be worth checking out.
Absolutely. For example, you've got the HDFC Top 100 Fund. It's in that large cap category. Over the last 20 years, its annualized return has been, wait for it, 16.5%.
Okay, that's a decent jump.
Which means your money would have multiplied, get this, over 21 times in those 2 decades.
Wow.
Now, if you're eyeing mid-caps, there's the Nippon India Growth Fund.
Okay, heard of that one.
It's rocking a 19.7% return over those same 20 years.
So we're talking almost 36 times growth.
You got it.
Okay, those are some juicy numbers, but let's face it, the stock market isn't always a smooth ride.
Well, tell me about it.
There are those stomach-churning ups and downs, the volatility.
Makes even seasoned investors sweat a bit.
How should we, wrap our heads around this volatility when it comes to investing in equities?
You've hit the nail on the head. It's something so many investors wrestle with. But this report, it actually gives us a really helpful way to reframe how we think about volatility.
Yeah, frame it. How so?
Well, it dives into data, real numbers. For example, it looks at the probability of negative returns.
Okay, the odds of losing money, basically.
Exactly. And it uses the Nifty Y50 TRI for this.
And a Y50, but with the dividends reinvested, right? A more complete picture.
Right on. So over a single day, the chance of hitting a negative return, well, it's pretty high.
How high are we talking?
About 83%.
Yikes. So if I'm checking my portfolio every day.
You're more likely to see those red numbers.
But if I just kind of ignore those daily swings and, focus on the long game.
Now you're talking. Over a year, that probability of negative returns for the Nifty Y50 TRI drops to about 67%.
Okay, that's better.
And over 5 years,
Let me guess, even lower.
down to around 26%. And get this, over any 7-year period.
7 years.
There's not a single instance of negative returns in the entire Nifty 550 TRI data set.
You're kidding.
Nope. The worst you'd have seen was still a positive return, about 5%.
So even though the market might be a bit of a roller coaster in the short term,
Up and downs, all that jazz.
over those longer periods, it tends to smooth out and, deliver those positive returns.
That's the historical trend. Pretty reassuring, especially if you're just starting out, right?
Definitely. And that kind of leads us to this age-old debate. Time in the market versus timing the market.
Ah, the classic conundrum.
Should we try to predict those perfect moments to buy and sell? Or is it smarter to just stay invested and ride those waves?
What does this report have to say about that dilemma? So where were we? Yes, that big debate. Time in the market, is it better than timing the market?
Right. Does the report give us any clues there?
Oh, it definitely leans towards staying invested, big time. It throws some pretty strong evidence our way. It points out that missing even a few of those, really good market days.
The ones that shoot up.
Exactly. Can seriously dent your overall returns. Picture this. You missed just the 10 best days for the market in the past 20 years.
Just 10 days.
You'd be looking at a portfolio that's 50% lower than it could be.
No way. Seriously. 10 days out of, what, thousands of trading days?
That's the thing. And they use a real example to drive it home. Let's say back in 2005, you put 10 lakh in the nifty Y50 TRI.
Okay, sizable chunk.
If you just stayed put, rode it out for those 20 years, you'd be talking crores today.
Nice.
But if you tried to time it, missed those crucial best days,
Oof.
you'd be kicking yourself big time, missing out on a huge chunk of those gains.
So basically trying to, like, predict the market's every move.
In and out, in and out.
It's a recipe for potential disaster. More likely to miss those gains than get it right.
The data seems to say so, yeah. And there's this whole idea, when the market hits an all-time high.
Sell, sell, sell.
Exactly. Like a crash is coming. The report actually tackles that head on.
So those headlines screaming, market at all-time high, correction coming.
Not always the best guide.
Really?
They looked at the nifty 50 TRI, what it did after hitting all-time highs. And get this, on average, the market kept going up for a year after those peaks.
Wait, so it didn't plummet?
Nope. Average return a year after hitting a new high, positive 14%. And over 61% of the time, those returns were better than 10%.
So hitting a new high isn't necessarily like a signal to bail.
Not at all. Could actually be a chance to ride that upward wave.
Interesting. So it's more about keeping your cool, not panicking when those headlines start blaring.
Staying the course, focusing on the long game.
Got it. But let's flip the coin here. Talk about those scary market drops. How often do they actually happen? And like, how long does it take to bounce back?
Totally valid concerns. The report digs into that too, using the Sensex, that index of 30 big Indian companies.
Yeah, the OG index going way back to 1980.
Brace yourself, because you might be surprised how often we see those drops.
Okay, hit me with it. What does the data say?
10, 20% drops in the Sensex. Almost every single year.
Every year.
Only 4 out of the last 45 years had smaller dips than that, intra-year.
So double-digit drops are like a regular thing. That's a little unnerving.
Big part of the landscape. But here's a silver lining. Even with those drops, most years actually end positive. 3 out of every 4 years, you're still in the green, even after those dips.
Okay, so it's not about avoiding drops altogether. It's about how the market recovers over time.
You got it. And the report, it gets granular. Looks at those massive falls, the ones over 30%. Those happen less often, maybe every 7 to 10 years.
Okay, so less frequent, but they do happen. What about the recovery time for those?
Historically, those big falls and then getting back on track takes about 1 to 3 years.
1 to 3 years. Okay.
But they also look at mid caps and small caps. Those can be even wilder, right?
Oh, yeah. Those are the ones that can really swing. But they also sometimes have the biggest growth potential.
High risk, high reward. The report really digs into those next.
Can't wait to hear about that. See how they compare to those big boys.
So about those mid caps and small caps, they can be a wild ride, right?
Oh, yeah. Way more volatile. But that also means, potential for bigger wins. What does the report say about them?
Remember how we talked about those Sensex drops?
The 10, 20% almost every year.
Right. With mid caps, it's even more common to see those dips.
Like how much more often?
They looked at the last 22 years, and only 3 of those years had intra-year dips, less than 10% for mid caps.
Wow. So practically every year, you're going to see a double-digit drop.
Pretty much.
Yeah.
And not just that, the size of those drops can be bigger too.
Okay, so more frequent A&D, steeper. Ouch. What about bouncing back? Does that take longer too?
Yep. Historically, that's the pattern. Those big market falls, over 30%.
Yeah, the ones that make you sweat.
For mid caps, recovering from those is usually taken like 2 to 3 years.
Okay, so got to be patient with mid caps, even more so.
The report even gives examples like the 2008 crash. Took the nifty mid cap 100 over 2 years to get back to its peak.
Makes sense. All right, now for the most volatile of them all, small caps.
Buckle up. These guys are even more prone to those big swings. Only 1 year out of the last 21 had an intra-year decline less than 10%.
So basically, a double-digit drop is almost guaranteed every year with small caps.
That's what the data shows. Higher risk, but also that potential for higher growth, right?
Got to be able to stomach the roller coaster, that's for sure. So are small caps worth it? I mean, do they actually grow faster?
That's the trade-off, right? Hard to say definitively. But again, the report really pushes that long-term thinking, especially for small caps. It looked at the data since 2004, and on average, bouncing back from big falls took almost 3 years for small caps.
Wow, almost 3 years, so definitely not for the faint of heart.
Nope. But no matter what size company we're talking about, big, medium, small, the takeaway is the same. Don't bail when the market dips.
Write it out, right?
Exactly. The report actually shows this cool chart, the Sensex, all its ups and downs since 1980. It makes it super clear, yeah, there are drops, but over time, the trend is upwards.
Gotta zoom out, see the big picture.
100%. Now, another thing the report dives into is diversification, not putting all your eggs in one basket.
Right, spreading the risk. But how do you actually do that, effectively?
They emphasize that over time, different types of investments, they take turns being the top performer.
Like a rotation.
Yeah. So if you're only in, say, equities, you might miss out when something else is booming.
Makes sense. So how do they suggest we diversify?
Well, they use this thing called rolling returns data. For example, they looked at 5-year periods and a portfolio with 70% equities and 30% debt. 78% of the time, that combo gave returns over 10%.
Okay, so even with a good chunk in equities, you're still getting decent returns pretty consistently.
Exactly. Plus, having that debt portion, it kind of cushions the blow when the market dips.
Right, so less risk, but probably also slightly lower returns overall in the long run.
There's always a trade-off.
Yeah.
But the report gives you the data, so you can see those different scenarios and make the choice that fits your goals.
This is great stuff. Really helps you have those conversations with your financial advisor, make smarter decisions.
For sure. And they also talk about managing your own behavior as an investor. All the data in the world won't help if you're letting emotions drive the bus.
Oh, I know that feeling. Market goes up, I get greedy. Market goes down, I panic. How do they suggest we avoid those traps?
They say don't chase performance. Don't just jump into whatever's been hot lately, thinking it'll stay that way.
So those top performing mutual funds might not stay on top forever.
Exactly. They show data that proves that. Instead, look for funds that have a good long-term track record.
Consistency is key, not just the flavor of the month.
Exactly. Once again, zoom out, see the big picture, don't get distracted by the noise.
Love that. Well, this deep dive has been amazing. We've covered so much from the Funds India report, the market ups and downs, the power of starting early, and the whole diversification thing. Really eye-opening stuff.
Totally agree. Really highlights how we can use data to be smarter investors, not just reacting emotionally.
Absolutely. So any final words of wisdom for our listeners before we wrap up?
Just remember, this report is packed with great info, but past performance. It's not a crystal ball. The market's always changing, so stay informed, adapt, and don't be afraid to get advice from the pros. But most importantly, keep learning, keep exploring, and investing will become less of a mystery and more of an adventure.
I love that. Investing as an adventure. Well said. And to our listeners, what are your big takeaways? What new questions popped up for you? Hit us up on social media. We want to hear from you. Until next time, keep learning, keep investing wisely. This is The Deep Dive, signing off.